The biggest tax mistake you can make as a business owner. Hey, my name is Sherman, the CPA, and today I want to help you stay in tip-top tax shape by helping you avoid the number one tax mistake I see amongst my small business clients. Look, I get it. We are in the middle of the tax year right now, and I know you're out there making things happen. You are closing deals, you're signing contracts, you're getting clients and customers, you're making money, and hopefully you are absolutely killing it in your business right now. And while you're on this channel, I hope you're taking full advantage of the tax strategies we are giving you to help you maximize your deductions and avoid as much taxes as legally possible. But there is this one little thing that is extremely important for you to be doing right now. And if you are not doing this, you can end up losing a lot of your tax deductions and end up owing more money to the IRS. And I don't want to slow you down while you're out there trying to grow your business. So if you want to stay on top of your tax game, just stop what you're doing for a few minutes and watch this video until the very end. All right, so here is the deal. As a business owner, the most powerful way to reduce your tax bill is to maximize your tax deductions. But a lot of business owners I talk to are completely messing this up. I am finding entrepreneurs who are not deducting their expenses at all. And even more common now, I am finding entrepreneurs claiming tax deductions that they cannot prove to save their life. So I want to spend some time with you to refresh you on the power of tax deductions, and more importantly, inform you of your responsibilities to prove that your tax deductions are legitimate, and I'm going to tell you exactly what you need to do. So let's start with the power of tax deductions for your business. Look, as an entrepreneur, you have an amazing benefit that 90% of people will never be able to do, and that is the ability to pay taxes on your income after deducting your expenses. Whereas everyone else in the world pays taxes before they even get paid and then hope for a tax refund at the end of the year. So for example, if you make $100,000 in your business and it costs you $50,000 to earn that income, then you would only pay tax on the remaining $50,000 in profits. Whereas if you were an employee who earned the same amount of money, you would be able to deduct zero. Even though they might work from home, dedicate space in their home for their work, use their Wi-Fi, their own cell phone, and so on for their job, they are still not afforded the ability to use their expenses to lower their income and pay less taxes like you do. Tax deductions are the biggest ways you can put more money into your pocket as an entrepreneur. So the first big thing to make sure of here is that you are taking them. I once had a client who made $500,000 in revenue and only profited $75,000. But when they filed their taxes, catch this, they reported their income as $500,000. Let me break this down so you understand the gravity of this mistake here. Let's just say their effective tax rate is 25% for simplicity. Well, in that case, they should have paid 25% of $75,000 in taxes, which would be around $18,750. But instead, they paid 25% of $500,000, which is $125,000 in taxes. They paid $100,000 more in taxes because they failed to take their tax deductions altogether. As a business owner, you cannot afford to miss any tax deductions, let alone all of them. So first and foremost, make sure that you are keeping up with your expenses, doing your books, and have competent support to claim those tax deductions before you file your return. Now let's talk about a far more common and important mistake I want to share with you: claiming tax deductions that you cannot prove. Listen, according to the tax law, it is your responsibility to prove the legitimacy of your tax deductions if it is questioned by the IRS. If the IRS sends you a letter and wants to learn more about a deduction on your tax return, you have to send information to support the deductions you claim. And if you are unable to do that, they can disallow the tax deduction altogether, resulting in a tax bill which may include more tax, interest, and penalties. Even if you take a perfectly legal tax deduction, it may still be disallowed if you cannot provide sufficient details to prove the legitimacy of it. So let's talk about what supporting documentation the IRS requires so you will not run into this issue in the future. So the IRS requires two things. Number one, a record-keeping system that clearly shows your income and your expenses. And number two, supporting documentation to support records in that system. Let's make sure you understand both of these requirements. So what is a record-keeping system? This is basically your accounting system. Every transaction that goes in and out of your business is a record. All of those transactions should be recorded in your business books. Now, the IRS does not specify how you are supposed to do this. Of course, in ancient times, business owners had to do this by paper and pen, which was upgraded eventually to spreadsheets. And today we have software that automates most of this for you. So it's your choice, but if it were me, I would go with the easiest option, and that would be using software like QuickBooks Online. And if you want a discount on that, just check out the link in my bio. But regardless of what you do have a record-keeping system. Next, you need to keep up with supporting documentation. Well, what is that? In general, this includes receipts, invoices, bills, or canceled checks to support expenses in your accounting system. If the expense is greater than $75, then you are required by law to keep up with supporting documentation to support the expense. Now, this is not required for expenses less than $75, but it may still be helpful to keep up with your documentation. Now, here's another thing a lot of people do not know. There are certain expenses where more documentation is legally required. And those are for expenses that the IRS are more skeptical about, like travel, transportation, meals, and gift expenses. For these types of expenses, you need to keep a log, agenda, diary, or something of that sort that documents the details of each expense you incur for that category. For example, for business travel, you have to document these things for each expense. Number one, the date of your business travel. 2, where you travel to and from. 3, the business purpose of the travel. 4, the mileage to and from the place that you are coming from. 5, the type of expenses incurred. And number 6, the amount of the expense. Now, we hear a lot about how people write off their G-Wagons and other business vehicles, but we don't hear about the work they are supposed to be doing to prove that they are using their vehicle for legitimate business reasons. And unfortunately, a lot of people miss this step, in which case the IRS can disallow their deductions completely, resulting in more money due to them. A similar level of detail is required for meal expenses, gift expenses, and other types of travel expenses. But in general, you need to log the business purpose of the expenses you are claiming as tax deductions as you are incurring them. If the IRS comes knocking on your door, you want to be prepared. And you can be prepared by simply keeping up with your receipts, your invoices, and other necessary documents to prove the legitimacy of your tax deductions. After all, it is your most powerful tool to save on taxes. Hey, look, if you really want to stay on top of your tax game, join my exclusive tax club at mycpacoach.com. Members of my tax club will get access to my premium tax savers course and access to private training calls with me and Crystal A CPA on a monthly basis. Just go to mycpacoach.com to learn more.